Hello and welcome. Well, there is a lot going on in markets this August. In the UK, the release of July wage and inflation data showed that the Bank of England still has a problem to deal with. The solution to that problem will involve further interest rate rises. And the money markets now have increased the peak rate that it thinks the Bank of England will reach to get to 6%. The sticking point is not just the cost of services, which are driven by higher wages. The wall of inflation worry extends out to core goods as well, with core non-durables like soap or medicine still above 10%, and semi-durables like footwear above 5%. In the US, the Federal Reserve released the minutes to their policy meeting, and the markets interpreted the Fed as having a slightly higher bias for higher interest rates. And this was reinforced by a strong set of economic data that was more positive than markets have expected. So the upshot of these developments has been a rise in government bond yields, dashing investor hopes that central banks either side of the pond can start to ease rates anytime soon. So elsewhere, developments in China continue to disappoint. Economic data remains lackluster, and the wider rebound after COVID restrictions were lifted at the end of last year has not been sustained. Chinese policymakers have responded by cutting rates, intervening in the currency markets to support the renminbi, and encouraging state-controlled companies to buy back their own shares to instill confidence. If maintained at the end of the year, the year-to-date slide in Chinese equity markets will extend the annual losses to 3 consecutive years. And this compares to a decent year this year in global developed equity markets. Some of the structural problems faced by China, which include their banking sector, their property markets, they're becoming more visible while the growth boost from exiting COVID lockdown is fading. So we have changed our thinking on China, on our equity exposure there and emerging market exposure in general. I don't want to leave, though, on a negative note. As I mentioned at the start, economic data in the developed world is proving to be quite resilient of late, and that bodes well for general diversified exposure to risk assets, which have put in a good performance so far this year, with year-to-date being around 6% in pound sterling terms. Thanks for watching.